Hello, fellow Rebel Capitalists. Hope you're well. The CPI print is out. It is officially 8.5% down from 9.1. So we're seeing this massive disinflation in the markets, in the economy. Yeah, right. So first and foremost, as you know, I make very few predictions. One of the predictions I did make is that we would have disinflation. Now, I didn't get it exactly right because about 4 months ago, I did a whiteboard video saying that I thought we'd see some disinflation in Q3, Q4. So I believe it's Q3 right now. Josh, correct me if I'm wrong. And so we're seeing, I don't know if you'd call it 9.1 to 8.5 disinflation, but it is going down slightly. But about 3 or 4 weeks ago, I did a whiteboard video. I said, I don't know, because the average American still has so much more in their checking account. And because we do have structural inflation issues with the supply chains and whatnot, I thought, well, I still see that we're going to get disinflation, but maybe it's going to be Q4, Q1. So I kind of got it right. I kind of didn't get it. I didn't get it exactly right because I kind of changed my prediction a little bit. But there you go. I think it was easy to tell that at some point we'd get some disinflation because inflation never goes straight up. It's nothing does. So look at the 1970s. Look at even with Arthur Burns, the inflation went up, goes down, goes up, goes down. It doesn't come back down to the same low or the previous low, but like it did in the 1940s. But that's just the way things work. It's kind of in cycles. It's in trends. So we'll probably see the CPI from here go down a little bit. What I was saying in that first video when I predicted disinflation in Q3, Q4, I thought it might come down to maybe 6%, 7%, something like that. But we'll have to see how it plays out. I mean, will it come down that far? I don't know. It might come down lower. That's what makes the world of macroeconomics so fascinating. So let's get into how the markets are responding. Let's go to the CNBC homepage. And Dow futures were way up. Let's refresh here. So the Dow is up 445 points. Now, or that's pre-market. That should be, the market should be open. Isn't the market open, Josh?
Yeah, that's live data right there, what you're looking at.
Yeah, it says pre-market. I don't know why it's doing that. But regardless, it looks like the market's up about 445 points. S&P up about 69. So about 1.3, 1.6%. NASDAQ up, call it 2%. So, I mean, honestly, I think this is kind of a bit of a knee-jerk reaction because when I was thinking this through earlier, I thought, okay, down to 8.5, is that really that much of a difference? I don't think so. I know a lot of the people on CNBC are coming out and saying that this means the Fed will only raise rates by 50 basis points next time they meet instead of 75. And I don't know that that's massively impactful for the companies in the stock exchange. I don't know if that's a big deal. I get the argument. The argument is, well, inflation's coming down, therefore the Fed is going to pause or they're going to pivot even earlier because inflation is going to come back down to their target of 2%. And when they come back down, the stock market's going to rip higher. So everybody buy now in anticipation of that happening. But what I really think this ignores is the bond market and the yield curve. Right now, or just as of yesterday, last time I checked, the 1 and the 10-year was inverted by over 50 basis points. As Lynn Alden, my good friend and partner in Rebel Capitalist Pro, pointed out, that was the biggest inversion we have seen since 2000. And prior to that, you'd have to go back to, I believe, 81 or so. Yeah, most likely 81. I'm sure we didn't get that much of an inversion in the early 90s. So the, the in my opinion, the bond market isn't just saying that inflation is going to come back down to 2%. The bond market is saying inflation is going to come back down to 2% because the economy goes into a massive recession. Or, and this is something that I don't see anybody talking about, it's predicting a black swan type of event. It's predicting like a GFC. And everyone that I hear, I was listening to a Twitter meetup or whatever it's called. And my sister was giving me, I don't watch CNBC. So my sister was giving me kind of the lowdown on what they're saying. And everyone is just thinking this through as though, well, okay, we're going to see some disinflation. Inflation's going to come back down just because it's just the supply chains are being fixed. It's just working its way through the system. It's like the snake eating the pig, as my buddy Adam Taggart says. And, it's just running through the system and no problem. As if the reason we see CPI coming back down has nothing to do with the United States potentially being in an economic recession, or that we're seeing the preview for that right now. I mean, the bond market, again, is predicting not just a recession, it's predicting a severe type of recession. Like I said, potentially a black swan event like the GFC. So that's why it's predicting that inflation is going down. So I think the market and the talking heads are just out there thinking that inflation is just going to come down just because it's just coming down because that's just what it's going to do. And not connecting the dots and asking, okay, why is inflation going to come down? And if inflation comes down as a result of the United States being in an economic depression or some sort of GFC type of event, would that warrant the stock market going up or down, regardless of what the Fed funds rate is doing? This is what I think, and I don't want to be sensational, and I don't want to be hyperbolic here, but it's not just me saying these things. It's some really, really, really smart people out there that like Snyder. Let's give him credit, and Emil. And I'm talking to Tracy Shukart here in about a half hour. But and it's not just those people. It's the market itself, and the bond market is rarely wrong. So it is some of the times, as far as I would say that the bond market is wrong from a standpoint of getting a real return on your money, because often there's negative real rates. But it isn't that wrong when it comes to predicting an economic hardship or an economic recession, depression, or potentially even another global financial crisis. And this is, again, I think the stock market just whistling right by the graveyard. They're just in their minds, they just see inflation down, therefore in the very soon in the future, interest rates down, therefore stock market up. Buy. And there's just it's just first level thinking. There's no deeper analysis than that, and asking, well, why? Anyway, that's my rant for the morning. So let's get on to how the markets are responding. Bond market, 10-year. I know when the news came out, the 10-year dropped to 2.7, now back up to 2.73. But I mean, yesterday, before we got the before we got the CPI print, it was at like 2.79. So, I mean, okay, we're talking 6 basis points lower. I don't know that that's a huge deal. And let's see, let's look at the 1 year because we just talked about that. So 10-year at 2.72, the 1 year at 3.21. So we do some quick math here. We're basically 50 basis points, roughly 50 basis points. So nothing much has changed there. 6 month, I'm looking at this here, make sure it's updated. Yeah, about 3.03. So still a huge inversion there. Let's look at the 3 month. So 3 month at 2.6. So I think this is really the biggest news in the bond market right now. 3 month at 2.6, where the 10-year is at 2.7. 10 basis points. And if you, I know you guys don't watch every one of my whiteboard videos, but if you watched the whiteboard video where I talked about, it's the one where I was being sarcastic, and I was talking about, and where Josh was like chiming in, and one of the things Josh reminded me of, or brought to my attention in the video, was the fact the yield curve was starting to invert in shorter and shorter time frames. So in this video, I showed a blog post the Fed did, where they basically said the 2-year, 10-year inversion means nothing. It's irrelevant. And it has no predictive power whatsoever. And the only thing that really, really predicts a recession is if the 3 month and the 10-year is inverted. But they said that will never, ever, ever happen, because if it gets close to the 3 month inverting, then the Fed is just going to go ahead and drop rates. So there won't be an inversion, and we're done. No problem. Nothing to see here. Let's move along. The Fed's got it all under control. That was the gist of the blog post. And I can't recall how long ago that was written. But today we see 10 basis points in difference, delta. And I would be willing to bet that in the next couple months, or maybe in the next couple weeks, you're going to see the 3 month invert. So I would love to get that the author who wrote that blog piece for the Fed to come onto the Rebel Capitalist show, so I could interview that person and say, well, it looks like the Fed ain't so smart, are they? It looks like inflation might have something to do with this, and there might be something else going on here behind the scenes. Anyway, that's just my thoughts on the bond market. Nothing much has changed, but this is the biggest news, if you will. So going back, let's just take a look at oil. Oil is under 90. It's been under 90 for the last on and off the last week. It got up to maybe 93 or 94, I believe, yesterday, the day prior. So now coming back down 90, a little under 90. So this would be the oil market saying that aggregate demand is going to collapse as well. Gold a little bit higher. Not much. I think that kind of had a knee-jerk reaction and went up to maybe 1830 or 1840, but now it's back down. And Bitcoin, as you would expect, is up quite a bit, 4%, 4.2%. And this, again, is no surprise because the NASDAQ is up by 2%. So Bitcoin trading alongside the NASDAQ, which is what you would expect. So this is pretty much how markets are moving. Again, what I think they're getting wrong, or what their blind spot, that's probably the best way to say it, is why inflation is going down. And I think this is what we need to ask ourselves. Why is the bond market predicting inflation goes down? Not just that it's predicting inflation is going to go down. And this is why I've got a lot of dry powder. This is why, with my model portfolio that I'm doing for Rebel Capitalist Pro, this is why I bought 1-year treasuries with a lot of the dry powder, because I believe, and I could be wrong. I mean, I'm just an amateur. I'm not a pro. I'm just some schmuck on YouTube. But in my opinion, you're going to see commodity prices hopefully come down pretty substantially because of what the bond market is saying, because of why we're going to have potentially disinflation. And then the Fed drops rates, not because they've beaten inflation, but the Fed drops rates because we have a financial crisis. The Fed drops rates because we're in an economic depression that no one can really predict, right? Or no one can really maybe predict what the catalyst may be as of right now, but the bond market sure is. And that's the big takeaway, I think, from this video. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. See you in the next video.